COMEX silver just had an enormous volume surge, what they aren't telling you. Right now, somewhere inside the COMEX vaults, a number just crossed a threshold that almost no one is watching. Not the price, not the headlines. Something underneath all of that. Something the charts don't show you at first glance. Silver just fell to a 7-month low, and in that exact same week. Trading volume exploded by numbers that have only been seen once before this entire year. That is not a coincidence. That is not retail panic. That is something far bigger, moving in complete silence. And while everyday investors were watching the price bleed red somewhere else, behind those closed doors, the largest players in this market were doing something very, very different. What they were doing, and why they were doing it right now, is the part nobody is talking about. Stay with this, because by the end of this video, you will understand exactly what this number means, and what almost always happens next. Now, before we go any further, I want to ask you for something, just one small thing. If you're the kind of person who values clarity over noise, who would rather understand what is actually happening with their money than just react to headlines, then this channel was built for you. So if you have not yet subscribed, think of it the way you would think of keeping a trusted advisor on speed dial. Now, you do not call them every day, but when something important happens in the markets, you want to already be connected to the right voice. That is what subscribing does here. One tap, that is all it takes. And now I would love to know, where in the world are you watching this from today? Drop your city or your country in the comments below. It always means a great deal to see just how far this conversation reaches. Now, let us get into exactly what happened at the COMEX this week, and why it matters more than the headlines are letting on. On Wednesday, June 24th, something unusual happened in the silver market. Most people did not notice it. They were too busy watching the price. That week, silver's price dropped hard. It fell more than 6% in a single day. That brought the price down to its lowest point in 7 months. For an average investor watching their portfolio, this looked like bad news. It looked like fear. It looked like the kind of day where people sell because they are scared. But underneath that price drop, something else was happening, something much bigger. While the price was falling, the trading volume on the COMEX was doing the exact opposite. It was rising, not slowly, not steadily, it was exploding. By the end of that week, the total number of silver futures contracts traded had reached a level far beyond anything considered normal for 2026. In fact, it was one of the largest trading weeks of the entire year. Analysts who track this market closely could see the pattern building day by day. It started quiet, then it picked up speed. Then, on that Wednesday, it became something else entirely, a flood. This is where the story becomes interesting. When a market sees a falling price and a massive surge in volume at the same time, it usually means one of two things. Either it is the final moment of panic, where weak and fearful investors are giving up and selling everything they own, or it is something more deliberate, something done by large, well-funded players who know exactly what they are doing. The truth is, these two things are not separate. They often happen together. And when they do, the second group benefits from the first. Here is what makes this moment different from ordinary market noise. While the price was crashing on paper, something quiet but important was also happening in the physical silver market. Real silver, real ounces, were still being moved. They were being claimed. They were being delivered. The demand for actual physical metal did not disappear during the panic. If anything, it kept grinding forward in the background, almost unnoticed. This created a strange and important contradiction. On one side, the paper market was telling a story of fear, weakness, and capitulation. On the other side, the physical market was quietly telling a story of accumulation. Two opposite stories happening at the exact same time in the exact same metal. For most people watching the news that week, none of this was visible. They saw a falling number on a screen. They assumed it meant silver was becoming less valuable. They assumed the smart move was to wait, or worse, to sell. But for those who study how markets actually work behind the scenes, this kind of moment tells a very different story. It often means something is shifting, quietly, below the surface, long before the average person can see it in the headlines. History has shown this pattern before. Moments when paper volume spikes to extreme levels while the price is falling sharply have often marked turning points, not collapses. They tend to appear right before deeper shifts begin to unfold. Not always immediately, sometimes not even within days or weeks, but the pattern itself has repeated enough times to deserve attention. So the real question is not simply, why did the price fall? The real question is, who was trading in such enormous size while everyone else was running for the exit? Because someone was, and whoever they were not behaving like a frightened retail investor checking their phone in a panic. They were behaving like someone with a plan, someone with patience, someone with resources that most people watching this market simply do not have. This single week, on its own, may not change everything, but it raises a serious question for anyone paying close attention to how money moves at the highest level, a question that deserves a closer, more careful look. And that is exactly where this story is about to go next. To understand what truly happened that week, the numbers need to be laid out clearly, not as scattered facts, but as a sequence. Because when looked at in order, the pattern starts to tell its own story. In a normal week throughout 2026, silver futures contracts on the COMEX typically traded somewhere between 160,000 and 200,000 contracts. This was the baseline, the rhythm, the expected pulse of a market behaving as it usually does. The week ending June 24th broke that rhythm completely. It started on a quiet note. Early in the week, trading sat well within the usual range, nothing alarming, nothing that would catch the attention of anyone outside the industry. But as the days passed, the volume began to climb, slowly at first, then with increasing speed. By midweek, the pace had already pushed past what would be considered a typical day. Then came Wednesday. On that single day, volume surged to a level that, on its own, nearly matched what the entire market often sees across several normal trading days combined. When the full week was added together, total volume reached roughly 275,190 contracts. That is not a small deviation from the baseline. That is an increase of close to 70% above the average. For a market the size of COMEX silver, that kind of jump in a single week is rare. It is the type of number that, when analysts see it appear on a chart, makes them stop scrolling and start paying closer attention. Now here's where the story becomes more layered, not less. At the very same time this volume explosion was happening, the physical side of the silver market was telling its own separate story. On that same Wednesday, COMEX issued delivery notices for 50 contracts under the standard 5,000-ounce contract size. That works out to exactly 250,000 ounces of physical silver called for delivery in a single day. That number by itself might not seem extraordinary, but when placed into the bigger picture of the month, it becomes far more significant. By that point in June, total month-to-date deliveries had already climbed to nearly 2,474 contracts. That converts to more than 12.3 million ounces of physical silver accounted for in just that 1 month alone. This is the contradiction that deserves attention. While the price was collapsing and paper volume was surging at a pace rarely seen all year, real physical silver was still quietly leaving the system in large amounts. Demand for the metal itself did not disappear during the panic. It continued, almost undisturbed beneath all the noise happening on the price charts. Two markets, two completely different stories, happening inside the very same asset during the very same week. On one side sat the paper market, where fear, speed, and forced selling appeared to dominate the headlines. On the other side sat the physical market, where steady patient accumulation continued without interruption, almost as if none of the panic above it mattered at all. This is the part that rarely gets explained clearly to the public. Most people only see the price. They see a red number on a screen and assume that number tells the whole truth. But price is only one layer of a much deeper structure. Beneath it lies positioning, contracts, deliveries, and decisions being made by entities operating on a completely different timeline than the average investor. It is also worth noting how this week compares to the rest of the year. According to the data, the only other period that came close to this level of intensity occurred back in early June, during another sharp liquidation event. Outside of those two moments, nothing else in 2026 came close to matching this kind of volume surge. That detail matters. It means this was not simply a random, isolated spike. It was part of a pattern beginning to repeat itself within a fairly short window of time. So now the picture becomes clearer, even if the full meaning is still forming. A market under visible stress on the surface, a steady, quiet accumulation of real metal underneath, and a volume pattern that has only shown this kind of intensity one other time this entire year. The next question becomes unavoidable. What actually causes a market to move like this? What forces are powerful enough to create this kind of split between paper panic and physical strength? To understand why the silver market moved the way it did, it helps to step back from the numbers for a moment and look at the machinery underneath them. Because a volume surge of this size does not happen by accident. It happens because of a specific chain of events, one that has repeated itself throughout financial history, long before silver and long before COMEX existed in its current form. At the center of this chain is a simple concept: leverage. Most of the trading volume seen on COMEX does not come from people buying physical silver outright. It comes from contracts, agreements to buy or sell silver at a future date, often controlled with a small amount of capital compared to the full value of the metal involved. This allows traders to control large positions without paying for them in full. It is efficient, it is common, and under normal conditions, it works exactly as intended. But leverage carries a hidden cost. It amplifies movement in both directions. When prices rise, leveraged positions can produce strong gains. When prices fall, those same positions can unravel just as quickly, sometimes faster than the trader can react. This is where stop-loss orders come into play. Many large positions are protected by automatic instructions. If the price falls to a certain level, the position is closed immediately, without hesitation, without emotion. These orders exist to limit damage, but when enough of them are triggered at the same time, they stop protecting the market and start accelerating its decline instead. This is the mechanism known as a liquidation cascade. It begins quietly. A price dips slightly. A handful of stop-loss orders trigger. Their automatic selling pushes the price down just a little further. That small additional drop then triggers the next set of orders sitting just below it, and the next, and the next. Each wave of forced selling creates the exact condition needed to trigger the following wave. The process feeds itself, growing larger and faster the further it travels. This is not driven by opinion. It is not driven by belief about silver's long-term value. It is mechanical, automatic. Once it starts, it tends to continue until the pressure has nowhere left to go. In the case of that week in June, this mechanism appears to have been set into motion by two outside forces arriving close together. The first was a strengthening US dollar, which moved firmly above a key psychological level. A rising dollar typically places downward pressure on precious metals, since they are priced in that same currency. The second was renewed geopolitical tension near the Strait of Hormuz, a region whose instability tends to ripple quickly through global markets, often increasing uncertainty rather than resolving it. Individually, either of these factors might have caused a modest reaction. Together, arriving at the same time, they appear to have been enough to tip a heavily leveraged market past its breaking point. This is the part of the story that explains the strange contradiction discussed earlier. The forced liquidation cascade explains why paper volume exploded and why the price fell so sharply in such a short window. It was not driven by a sudden collapse in the belief that silver holds value. It was driven by mechanical, automated selling, forced upon traders whose positions could no longer be sustained. Meanwhile, this mechanism says nothing about the physical market. The deliveries, the accumulation, the steady demand for real silver, none of that is connected to leverage or stop-loss triggers. That side of the market moves according to entirely different motivations, often shaped by entities with far longer time horizons and far less concern for short-term price swings. This is precisely why these two markets diverged so sharply during the very same week. One was being shaken by forced automatic selling. The other was continuing its quiet accumulation untouched by the panic happening just above it. Understanding this mechanism changes how the entire event should be interpreted. It was not a signal that silver had lost its value. It was a signal that leverage, once again, had reached its limit. And that distinction is about to matter a great deal. Once the mechanism is understood, the real question shifts. It is no longer about what caused the price to fall. It becomes about what this kind of moment has historically meant for those paying close attention, and why it tends to matter more to serious decision makers than to everyday observers. Throughout financial history, markets rarely move in a straight line toward their true value. Instead, they often overshoot. Fear pushes prices lower than fundamentals justify, just as greed can push them higher than fundamental support. The forced liquidation event described earlier is a textbook example of this kind of overshoot. It was not driven by a reassessment of silver's long-term worth. It was driven by leverage, reaching its breaking point automatically, mechanically, without regard for value at all. This distinction matters enormously for how the event should be read going forward. When paper markets panic, while physical demand continues quietly in the background, history suggests this divergence rarely resolves in favor of the panic. More often, it resolves in the other direction. The weak, over-leveraged positions get cleared out of the system. What remains afterward is a market with less excess, fewer fragile positions, and often a more stable foundation for the next significant move. This is precisely why large, well-capitalized entities tend to behave differently during these moments than the average participant. And while retail traders are reacting emotionally to a falling number on a screen, larger players are often doing the opposite. They are accumulating, quietly, patiently, without urgency, because they understand that price weakness caused by forced selling is fundamentally different from price weakness caused by a genuine loss of demand. The physical delivery data from that same week supports this interpretation. Real silver did not stop moving. It did not stop being claimed. If anything, the numbers suggest the opposite of panic was occurring beneath the surface, even as panic dominated the headlines above it. This is the core lesson buried inside this entire event. Short-term price action and long-term value are not always telling the same story. Sometimes they diverge sharply, and the divergence itself becomes the signal worth watching far more closely than the price alone. For decision makers, this distinction carries real weight. Those who only react to price often find themselves selling at the worst possible moment, precisely when leveraged weak hands are being flushed out of the system. Those who understand the deeper mechanics, the relationship between leverage, forced selling, and quiet accumulation, tend to interpret the same event in an entirely different way. This does not mean every volume spike leads to an immediate recovery. It does not mean timing can be predicted with precision. Markets remain unpredictable in the short term, and other forces, currency strength, geopolitical developments, broader economic shifts, will continue to influence price in the weeks ahead. What this event does confirm is something more fundamental. Beneath the surface noise of a single volatile week lies a structure worth understanding. A structure where forced liquidation and quiet accumulation can exist side by side, telling two very different stories about the same asset at the very same time. The cost of misreading this kind of moment tends to fall on those without the patience, the information, or the capital structure to see past the panic. Those who take the time to understand the mechanics underneath the headlines are the ones positioned to interpret what comes next rather than simply react to it.